Throughout my time in crypto, I've run into a ton of solid traders who pulled off insane trades and made serious money. And I noticed they all share one trait. They periodically make trades that go against the crowd, against the general consensus, contrarian trades. I genuinely believe this is one of the core reasons behind their success. And that's exactly what I want to talk about today, because this principle is incredibly important, yet for some reason, nobody on YouTube is really talking about this. So what's the deal with contrarian trades? Let's break it down with the most iconic examples in crypto. If you've been around since at least 2021, you remember how Dogecoin was performing. Elon Musk was basically the ambassador of that pump. His tweets, his constant chilling sent this meme coin on a parabolic run. And here's the thing, right near the very top, legendary trader GCR started shorting it. Here's why that was genius. Any chart with a parabolic structure has the potential for an equally parabolic crash. Doge's chart was pure vertical, zero organic price action. The higher it went, the greater the risk of a collapse. The later you got in, the higher your chance of becoming exit liquidity for the smart money that entered early. But did the broader market understand this? Of course not. The crowd was completely blinded by euphoria, genuinely believing Doge was the next Bitcoin, expecting $2, $3, $5. The hype was so extreme that taxi drivers and housewives were talking about it. And that right there is the most obvious sign of an overheated market. When literally everyone is talking about an asset, the top is very, very close. GCR spotted this. The peak of the hype was Elon appearing on SNL, where retail expected him to pump Doge to the moon, an event with absolutely zero guarantees, yet the entire market was pricing it in. Longs massively outnumbered shorts on exchanges, a structural imbalance, and that's exactly when the contrarian play kicks in. Everything goes the opposite way. Elon showed up, didn't deliver what the crowd wanted, and the asset started dumping. Now imagine telling people in the middle of that euphoria, hey, I've analyzed the data and this coin is about to crash. You'd get laughed out of the room. That's the essence of contrarian trading. You have to be ready to go against the crowd. Next up, Solana after the FTX collapse. SBF held a massive bag of SOL. After FTX went down and he got charged with fraud, a massive wave of FUD crushed Solana. The consensus? This coin is dead. But when it dropped below $10, smart money started accumulating. They saw the disconnect. The FUD just didn't match the fundamentals. Solana was still a fast, cheap blockchain with massive throughput and huge potential for dApps, DEXs, you name it. They made a bold bet at the bottom against the crowd, and as we know, it paid off big time, pure contrarian play. Next, DUB, a lower cap token on Solana, a real startup generating actual revenue, helping users find the best deals online. It pumped to a $7 million market cap, then pulled back over 80%. The crowd was convinced it was done, but contrarian traders saw the information asymmetry, a doxed team, a working product already generating revenue. Those who dug deeper captured a massive move. I know a trader who turned $4,000 into nearly $300,000 on this coin. So here's the big takeaway. All these setups share a fractal nature. The same structure repeats whether you're looking at large caps or micro caps, spot or futures, meme coins or blue chips. It's universal, and it's built entirely on behavioral game theory. Unlike classical game theory, in this framework, the player doesn't know all the rules and can't act rationally. They're driven by emotions, fear, greed, stupidity. Price action becomes non-linear, driven by psychology first and fundamentals second. Contrarian traders look specifically for this gap between the crowd's emotional reaction and the actual fundamentals. These moments keep repeating because people are emotional by nature, either too scared or too euphoric to see what actually underpins an asset. Now, how do you actually find these trades? There's no shortcut. You need to be present in the market and actively analyze what you observe. The best tool? A thesis-based trading journal, not just logging trades, but recording observations about macro trends and crowd behavior through the lens of game theory. When you spot a notable contrarian outcome, decompose it, break it apart to understand exactly why it happened. Almost nobody does this. If you do it even occasionally, you're already ahead. You won't find two identical setups, but over time you'll notice repeating patterns that help you make better decisions. I could list more examples like Terra Luna, where GCR also predicted the crash because the structural imbalance was painfully obvious. But you can find these yourself by studying the history of any major coin. Here's the bottom line. The first thing you gotta master isn't charts or liquidity, it's human psychology, because at the end of the day, you're trading against other people who want to take your money. All right, that's gonna wrap it up. I hope you guys got some value out of this. If you want to see more content like this, smash that like button, subscribe to my YouTube channel, and follow me on Twitter. See you in the next one.